I'm very happy to be hosting my good friend, Matt Pauker, for our episode of Compound Witness today. Matt has been a friend, an advisor, and just somebody who I've been able to rely on for just some incredible insights about entrepreneurship, about sort of doing business in Silicon Valley. And I've just learned from him so much over the years. I'm super pleased to be able to present some of our conversation today. Matt, welcome to the podcast.
Awesome. Thanks for having me.
Happy to have you. I think what would be great is if you could give the audience just a background about your path to entrepreneurship. I know you've had a deep background in crypto in the sense of you started a crypto company, specifically a Bitcoin company, before I think most people knew what a Bitcoin company was. So I'd be happy to hear that journey. So I would love to kick it off with just a background of yourself and your path to where you are now.
My path to entrepreneurship and crypto actually, kind of began simultaneously. And I like to joke it actually began back when crypto meant cryptography, not cryptocurrency. So, I was a computer science major at Stanford, and kind of as a focus area, spent a lot of time studying cryptography with Dan Bonet, who runs the crypto group at Stanford, and worked with him during my undergraduate time on a really interesting research project around a new public key algorithm that he had developed called identity-based encryption that we actually decided to spin out into a startup. And so graduated a year early and started that company, which was a cybersecurity enterprise software company called Voltage Security, essentially commercializing that algorithmic breakthrough into a set of software products for big enterprises, so customers like Wells Fargo and Walmart and Home Depot and Kaiser Permanente, and it was a great adventure. I was there 11 years full time, last 2 on the board, and we sold that to HP Enterprise, and so had spent many years kind of thinking both from a technical standpoint as well as kind of how do you build businesses, around cryptography and security, and it was interesting. In truth, I was in some ways a little burned out on crypto after a lot of years there. But then saw this thing called Bitcoin and was just fascinated because it was this incredibly interesting new application of a bunch of technology that I'd spent many years working on. That most interestingly was not really a security application, right? There are certainly obviously very important security aspects to Bitcoin, but fundamentally it's this kind of entirely new kind of value prop. And so decided to go leave Voltage and start my second one, which was a company called 21, later pivoted and became earn.com, but was one of the really kind of big early plays in the cryptocurrency space for a time. We were one of the largest Bitcoin miners in the world, actually. We sold that to Coinbase in 2018, and so have had the pleasure of building 2 companies broadly in the crypto space and working with a bunch of amazing people and just really getting to see firsthand how the space has matured and still now I am have come to the other side of the table. I'm a general partner at Cleo Capital. We invest primarily in early pre-seed stage companies with a real generalist focus, but still get to spend some time in crypto. We're investors as well in companies like Gemini and Falcon X as well. So it's been a real pleasure just to see the space mature over the last decade plus.
Such an incredible journey. I think given that you're a multi-time entrepreneur in many respects, 2 companies, with successful outcomes, but also now as a VC. What's your perspective of the things you've learned, from being an entrepreneur and now to being an investor?
It's certainly been an interesting shift. Building and operating and running a institutional venture fund is different in a lot of ways. And, it's great. Certainly Cleo is, we're a 2 GP fund, so we are certainly very much in build mode. And so, get to apply a lot of the lessons that I've learned over the years about, how do you build and scale an organization? But, they're certainly very different scale, right? Your goal as a company is to start as a couple people and hopefully end up, with, hundreds or even thousands in a relatively short period of time. Even the largest venture funds, 100 would be an extremely large, venture fund, right? And so the scale is certainly different. But what is great and what remains consistent, obviously, is what I love about early stage venture is the opportunity to think about interesting problems, work with really, really interesting, smart people. And the benefit of doing it as an investor is I get to have a kind of broader view and spend time with a lot of great entrepreneurs working on a lot of great different problems, as opposed to I certainly love founding companies, but you obviously have to be very, very focused on the one problem you're trying to solve. And so there's that certainly is one thing that I really love about being on this side of the table now.
I do want to spend some time talking about 21, and you kind of gave the broad overview. I'd love for you to give us the context and just the story, like how did it get started, where was the idea, and what was what was the strategy like, and sort of what unfolded.
The idea for 21 kind of began in kind of late 2012. So certainly there are obviously folks who had been working in Bitcoin for a few years at that point, but still certainly I think the only Silicon Valley company that had kind of really raised any meaningful capital at that point was Coinbase, and it was still very, very early days. They were still at that point very focused on helping merchants process Bitcoin transactions. And so there was obviously this time it was all Bitcoin. There was no Ethereum. Bitcoin was the one and only. And the theory was I became convinced that Bitcoin was a really important big breakthrough, and that there were going to be a lot of interesting applications that it could unlock. There were a lot of folks talking about kind of the analogies, in those days to the early days of the internet. And so the question was, okay, if you rewind time and you say it's the very early 90s, and you see you've seen this TCP/IP thing, and you say, wow, this is really interesting. What's the company you build at that point, right? And the answer, in hindsight, or an answer would be Cisco. And because ultimately, while it might have been hard to predict that we would end up with Amazon or Facebook or what have you, clearly the companies, and Cisco is historically dominant companies, kind of owning the infrastructure, have benefited from all of that massively. And so no analogy is perfect, but if you say, well, what is the analogy in Bitcoin? The closest is mining, and the Bitcoin miners are the infrastructure of Bitcoin. They're obviously responsible for creating the monetary supply, but I think in some ways, more importantly, they control the protocol, right? They get to determine, in large part, what features get added. They certainly determine, every miner decides what transactions it's going to include in the blocks that it mines, and so I think we saw a big opportunity to basically be the owner of that infrastructure. And so that was the theory of the case. And we were in the very early days at that point. There had been a handful of companies starting to ship custom built silicon ASICs for Bitcoin mining, and we thought we could compete there. And so that was what we ended up building.
I mean, what a different world than now, right? I mean, to your point, there was only Bitcoin, but even things like, custody is still a hard problem, right? And certainly for institutions, but, there was like, you met people on, like street corners effectively. And like, you had these like, maybe you had these like, these things on pieces of paper. And it was just so primitive in a lot of ways, but very exciting as well. And even, Coinbase, as it got its start, Coinbase and Ripple, some of those kind of original companies from that kind of vintage, it was like you could finally start buying things in sort of a little bit more of a legitimized way, which was fascinating. But like, yeah, what was like, I guess when you went around Sand Hill Road, if you did go around Sand Hill Road and talk to VCs about this, were most of them just like super skeptical about just the asset class overall? Or did you find like some believers? I'm just curious what like the thinking was back then. I think, people now look at Twitter, open up the Twitter, and they probably see Web3 everywhere. So it almost seems like a fait accompli, even though I'm sure it's far from that, as probably a lot of us know. But yeah, I'd love for you to just give a description of what that world was like. What it was like being an entrepreneur in a space that like probably nobody understood, or very few people understood back in 2012, 2013.
To give you a sense, that first round 21 we raised entirely from individuals. There was, and a lot of those individuals were our partners at big funds, but we actually didn't raise any fund capital at that point, in part because I think a lot of funds just didn't know how to think about the space and the risks involved and the regulatory risks. Well, there certainly remain regulatory risks in the space, but at that point they were much, they were much more significant, and I think a lot of folks were very kind of nervous about that. And yeah, certainly I had a lot of great investors that I'd worked with for years, and they I went to them, told them the story, and said, listen, would love to back you, but this is not something that I understand, and I have a lot of questions, and I'm not going to do it. But I think the good news is there obviously this is an industry, and Silicon Valley in particular is a place filled with a lot of smart folks who are willing to take big swings at things. And so we had a bunch of great investors from name brand funds, and it was interesting. There were certainly some people who already at that point I think had some understanding and some exposure to it, and maybe they'd run to know themselves, what have you. But I had one investor who was not really familiar with it. But the reason he wrote me a check was he said he is a collector of rare musical instruments. So he collects Stradivariuses, for example, and he saw some very interesting parallels between the ways in which Stradivariuses get used as collateral for things in financial transactions, where otherwise you don't have great kind of ways to collateralize them, and Bitcoin. And that was really interesting. So people, I think what's so fascinating about crypto broadly is people come at it and I think find interest in it from a wide variety of places, whether those are economic, kind of interesting economic interests, or political interests, or technical interests, which was certainly my case.
As the years have progressed, we have just so many people opining about the space, the asset class, like cryptocurrencies, blockchain technologies in general. I mean, there's some great investors out there, even who I admire, people like Warren Buffett, or even Bill Ackman from Pershing Square, who are not like the biggest fans of Bitcoin to varying degrees. I'm curious how your thoughts on the space have evolved, especially from somebody who was an entrepreneur for, from sort of very early part of the industry, seeing it grow. Obviously we had, the big, boom, but we have had several now boom bust cycles. What are your thoughts about, let's say, the near term, but also the kind of long-term things about this, this asset class? Like, what do we think? I mean, there's so much froth, and there's so much things said. How do we, find the actual signal in the noise? And what is your thoughts about kind of long-term things that will become valuable here?
There are people much smarter than me who spend much more time, day to day, in the weeds, and so I'm always cognizant of that. But certainly have been in and around the space for a long time, and what I would say is I would not call myself a bear, but I tend to be probably a lot more measured in my enthusiasm than a lot of people, and certainly among people who understand the space deeply. I think there are certainly lots of folks who will go on CNBC and say crypto is dumb and it's going nowhere, and just don't actually understand it. And that's just, that's a talking point. What's been interesting to see about crypto over the last 8-ish years, the number of just really, really smart people that are building, certainly technically really interesting things. I think that ultimately the big challenge for crypto is going to be finding a path from these very interesting technical innovations to products that have mass demand, whether that's consumer mass demand or enterprise mass demand. Because the truth of the matter is that at the end of the day, people don't buy technology. Obviously, they buy products that solve real use cases, and I think that there have been certainly, there's been a lot of money, frankly, poured, I think, into projects that perhaps don't actually have a clear set of use cases and customer value in mind. And that I think is not always, that's generally not a recipe for success. And so certainly the things that I find most interesting in the space are projects that can articulate what that value is. And one of the heuristics that I always share, when folks ask me, what do you find interesting in crypto? The heuristic that one of the heuristics I look at is do some of the last adopters of the product, project, technology, whatever you think about it is, do they get as much or more value as the early adopters? Because the truth is, it's very easy in crypto to construct a system in which the earliest adopters see huge benefits, often in the form of financial benefits. But that doesn't, that's not a recipe for sustainability. And the question ultimately is, to build a sustainable business of any kind, you need to have mass market appeal, and your last adopters need to get substantial value. And so Bitcoin, I think, is a project, a platform that I think has an argument that meets that heuristic, which is to say that if you think of the primary use of Bitcoin as a store of value for people who want to have a place to store their wealth that is outside of the control of banks or central banks, then you could certainly argue that in some ways, the latest adopters of Bitcoin, who are likely to see much less volatility in the currency, would find more value in that, because while obviously it's great if you buy Bitcoin and it goes up 20%, at the end of the day, if your use of Bitcoin is to be able to say, hey, I want to put my wealth somewhere where I know what it's going to be worth tomorrow, then what you actually want is very little volatility. And so I think Bitcoin is an example of a project that has an argument to pass that heuristic. I think there are a lot of projects that don't.
And actually, one of the things, obviously, inflation is big topic of concern, has been, but it's really coming to the fore. Even fiat. I mean, I think this is what people who love Bitcoin or other cryptocurrencies talk about. Even though you don't see the volatility because you think about things in US dollars. I mean, you're losing quite a bit of money every month on your cash balances, which is why I think so many investors think about that, right? But of course, it is got the longest track record. USD has a much longer track record than Bitcoin. So, we have still a lot of ways to go before we get those kinds of, that kind of history correlation to other asset classes. So if we think about, let's say, two applications, one being sort of store of value, and then the other one being, let's call it, decentralized applications, or maybe just even applications, just broadly speaking. We of course have things like Ethereum and a whole host of other layer 1 and layer 2 and beyond technologies. What's your view on that? I mean, I noticed you left Ethereum out of what you just said, so I'd be curious to get your thoughts on chains or on sort of blockchains that are like Ethereum.
You can clearly build things in a very unique way on a blockchain like Ethereum or similar. I think the question sometimes that doesn't get asked, that should be asked, is one of trade-offs, right? Which is to say, if you kind of boil it down, and I guess this is probably the computer scientist in me coming out, but if you think of, and I'll just use Ethereum just as the stand-in here, but if you simply think of Ethereum as an architecture on which you can build kind of applications and store data. It is one of a number of architectures that you could choose to use for deploying an application. And ultimately, I think the question is, okay, why do you pick this architecture versus others? A lot of folks very quickly just jump to the theory that a decentralized architecture is better. And I think what people sometimes fail to do, one, is articulate why is it better? Like, what are the actual benefits that you're getting from that decentralization? And in some ways, more importantly, what are the trade-offs you're making, and are they worth it? There are real trade-offs that you make when you build an application in a decentralized way around scalability and usability and performance. And undoubtedly, there will be technical breakthroughs over the next years and decades that help mitigate some of those trade-offs. But everything in life has trade-offs, and in the same way that as if you're designing a new data infrastructure, you're going to be very thoughtful about the database infrastructure that you're going to use. If you're building a real-time transaction system, you're going to go use a certain set of databases, and if you're building something for data analytics, you're going to use a different set of databases, right? It's always very important to be thoughtful about those trade-offs, and I think sometimes those are not made, and because again, the question is, well, if you were to build the system in a centralized way, what benefits are you losing? And I think often the benefits there tend to revolve more around the lack of a central authority. There is no central authority that can shut things down, that can moderate things, etc. And I have no doubt that there are certainly a number of use cases where that is actually one of the most critical features.
I'm not sure that that is true for all applications where folks have chosen decentralized architectures.
One of the things I've always enjoyed chatting with you, Matt, is about the fact that you're so deeply knowledgeable about the space. Like completely opposite of the CNBCers, or some CNBCers are great, but the ones I think we know and think about. And yet you have such deep, interesting insights around what the questions that we should be asking are. So I always appreciate that. I think the thing from the business perspective, I love that you approach it from the computer science side. On the business side, one thing I keep thinking about is there's this kind of model of business theory about how basically technologies form. It's related to Clay Christensen's disruptive innovation thing, but it's actually around integrated versus modular architectures. I believe you and I might have talked about this like a little while back, but across various industries, when you see the emergence of a technology, usually things that are integrated, meaning like vertically integrated from front to back, things that are in the iPhone is a great example, right? Or even the personal computer. But there's plenty of examples beyond the ones we know. But repeatedly, you find in the early phases of an industry, this sort of what you might call vertically integrated thing, where kind of a centralized authority sort of controls everything, they tend to succeed. And when the industry is mature, those companies usually fall away, and you have a much more kind of horizontally non-integrated thing where you have clean interfaces between technologies. That model, I don't quite yet know how exactly. I've been thinking about it a lot, but how do you apply that to something like this? But as you were talking about it, that almost reminds me of the same thing, right? Because it's from a business perspective, you're like, well, you see time and time again, technologies that are not vertically integrated tend to do poorly because like nothing, there's no like I said, clean interfaces. If we think of like, for example, interoperability between various layer one blockchains might be an example, right? So that's just a long way of saying I kind of support in that sense what you do. And I wonder like what that means for like what are going to be the applications that win? And do you have to have like some big gigantic company that integrates everything in the beginning for, these kinds of applications to work in the beginning?
I don't personally actually love the kind of Web 1, Web 2, Web 3 framing, but if we adopt that framing, certainly Web 1 was much more decentralized in a lot of ways. And then, Web 2 came to dominate and be much more centralized, right? And I think there are great arguments for why that has been not great for the world, but it certainly was what happened. I do think, to your point, I think there's a good argument, if you were to say, okay, what decentralized kind of application focused blockchain will win? And when I say decentralized application blockchain, I'm kind of separating out Ethereum from Bitcoin. There were, I think in the early days, people thought Bitcoin would get used for this, but I think the core nodes of Bitcoin have very clearly decided like that's not the direction they're going, which I think probably in some ways a good decision. But Ethereum obviously, has a huge lead at this point in terms of everything from obviously market cap, but more importantly, I think number of people building things and projects. I think it's a good argument that the winning blockchain will be the one where the first real killer app gets deployed, and that killer app will drag everything along with it. And maybe it's not necessarily totally vertically integrated, but to your point, it feels more likely. I think there's a good argument that if you say what's the dog and what's the tail, that the killer app is going to lead here. And now, this doesn't have an isolation. Obviously, the fact that Ethereum has so many more folks working on it and developers and so forth, like increases the likelihood that the killer app gets deployed there. Even if the protocols remain somewhat decentralized, that you will end up naturally, to your point, that there's some full stackness required here to make things work.
Yeah, most certainly. And going back to your earlier thoughts around, let's say, the store of value. I mean, is it in your mind, and we talked a lot about Bitcoin, but do you think Bitcoin? It's of course always hard to predict these things, but as you've seen it progress, do you have a strong, not strong, or negative conviction that like Bitcoin is going to be that, right? The use case for store of value, like that's the blockchain. It's got the network effects. It's got the proof. It's proven its sort of security over years. Or do you think that there's still a big chance that some other blockchain comes in and takes the whole store of value use case?
No, I think it's less about the security and the proof points, because I think at this point, Ethereum
there's enough money in it that if there was a major flaw in Ethereum, it would have been found. I think it's two things. One certainly is that I think the core devs at Bitcoin, and it's hard obviously because of core devs because there's a bunch of individuals, but as a kind of a collective, very clearly made the choice in kind of the middle part of kind of 2015 here, and I'm probably getting my dates exactly wrong, but like they very clearly decided to slow the protocol down and be extremely conservative, right? There were a whole bunch of things around block size, and there's a lot, and it obviously we've seen they have made improvements to the protocol, but they've been extremely measured. There's certainly never been any real discussion about changing proof of work, right? Like that's never really come into play. Whereas with Ethereum, obviously, it's been we've been almost talking about changing to proof of stake from day one, right? It's been kind of almost a foregone conclusion, and so to the extent that you are building an application that is around store value, you want something really, really conservative, and you want something that is unlikely to change in any meaningful way. Partly certainly because that could impact the security of it, but in some ways just because it might change the dynamics of the economy, and that would not be good if what you're trying to achieve is store value. In my mind, the threat to Bitcoin from a store value use case really comes from a Fed-backed dollar. So I personally think we're going to see at some point, I think sooner rather than later, a US-backed essentially stablecoin that is essentially tied to the dollar. And while I believe that there are certainly there are certainly people around the world who I think would want something that is actually disconnected from the dollar and essentially want gold. The truth is, I think the vast majority of people around the world would just love to hold U.S. dollars because the U.S. dollar, certainly we're seeing higher levels of inflation right now than we have over the last decade. But in the scheme of things, it is still a very small amount of inflation relative to what you see in other places. And certainly, and we saw just this week with announcements, the Fed is very aware of it. And I think there is, if anything in this country, we have seen over the last several decades, a bias towards overcorrecting inflation in some cases, as opposed to maximizing full employment. And so, I think that there remains a very strong argument that the US dollar is a great place to store your wealth. And I think that that's going to ring true for a lot of people.
I think bringing up, central bank digital currencies, CBDCs, and, we're seeing, efforts like that in various places around the world is so interesting. And wait till we see the day. I'd be curious to see what the crypto community's reaction to that sort of thing is. When, regulation is a big thing, right? I mean, I think there's some even, there's a lot of traditional investors who talk about how regulation is inevitable, which I think it is in many respects. The question is what kind of regulation and what's the form of that. But it's kind of the question around, there's of course the most extreme version of regulation, which is just simply to ban use, which is certainly not possible for a single country to do, but it could certainly make it very difficult for people to operate. I mean, certainly in smaller countries like Cyprus, that's, when I got really excited. I'd known about it before, but I decided to dive headlong in 2013 when the Cypriot government effectively put in capital controls. And so this little known thing called Bitcoin was how people were trying to get their money out, right? So ironically, that's what caused it to spike. We've seen that happen over and over again. I guess what are our thoughts around regulation? And you mentioned it. How does that interact with CBDCs or a Fed-backed digital currency? And also, the Fed, and what's interesting is the Fed doesn't play a consumer-facing role really today, right? It interacts with banks that then, interact with other banks and then finally at some point interact with us. Is that a schema where we think the Fed, well, there's a few schemas that could emerge if that were to occur. Is it going to be something like, the Fed still plays its kind of effectively B2B role, or I guess it would be G2B role, but maybe interact with brand new types of companies, not just, old school banks? Or do we think that they're just going to offer it directly to consumers and effectively have a new way of monitoring and control? Those are two, and there may be way other outcomes, but those are two categories of outcomes that would both be fascinating in their own, regards.
I know, I think it's a great point. And I think that certainly if the Fed went in that direction, you would obviously, I think, see, strong lobbying from both the established
financial services titans to play a role there, as well as I'm sure from some of our new crypto titans as well. And yeah, to your way, I think a lot of ways that you could imagine that working. And obviously part of it is really, I think, a question of what, from a technical architecture, what does that look like? It obviously would, the fact that the Fed controls it means that it is not fully decentralized in the way that Bitcoin is, but there's obviously levels of centralization. There's a gradient there, and I think a question of how how do things get minted, and how do transactions execute, and what is the level of anonymity on those? And I think there's a whole bunch of questions that you would have to answer around that. To your question around regulation, I think that in the U.S. at least, and I don't want to speak to other countries because I think my understanding of the U.S. is relatively limited. My understanding of other countries is near non-existent in terms of their kind of regulatory stance. I think the horse has left the barn to some extent on this, and that I don't think we're going to see a banning of. We're not going to see an outright ban of cryptocurrencies. I do think that we've seen a lot of discussion over the last month or so around what is the correct regulatory environment for stablecoins, and I think that that's really interesting. It may seem kind of niche, but to the extent that stablecoins at this point are a big driver of a big chunk of the crypto world, particularly the decentralized exchange world. A shift in regulatory environment there could have a major impact, and I think it's TBD. I think the truth is the real risk at this point that I perceive, that I think the crypto industry faces from a regulatory standpoint, is the risk that, like a lot of things in this country, it becomes a partisan issue. And we see what happens in this country with partisan issues. Like you don't want to be a partisan issue in this country for a whole host of reasons. And I think that there's real risk of that. Certainly, if you look broadly, I don't think it's necessarily a full kind of black and white clean split, but certainly you see much more support for crypto among Republicans and less among Democrats, and certainly the loudest voices on both sides of those tend to be pretty split. And it is what it is, but I think if I were the CEO of crypto, I would be trying very, very hard, and I am sure that the actual CEOs of big crypto companies are working at this, but I would be trying very hard to generate broad bipartisan support for crypto in some form. Otherwise, the real risk is that you end up in an unclear and uncertain regulatory environment, which in some ways is the worst thing, right? Obviously, the best case for crypto is a very liberal regulatory environment. The second best case actually is a very clear, less liberal regulatory environment. The worst case is a regulatory environment that keeps flopping back and forth depending on who's in power, because then it becomes very hard to know how you can build a sustainable business.
Yeah, I think that's absolutely right, and certainly risks entrepreneurial activity going elsewhere. I mean, obviously around the world, we're seeing in a variety of countries, the different kinds of entrepreneurial efforts and sort of the growth of that in this space. You said something that I never framed it that way before. It's one of those things that you don't think about, but once you say it, it's like, oh my goodness, how come I hadn't thought of that before? And that is around being the partisan issue. And actually, I never thought of it from that framework. But of course, as I think just as you were saying that, I was thinking through some of these hearings about like some of the comments from specific Congress people, and I'm afraid to say that seems like a real danger, because I don't tend to know the exact leanings of all the people I speak with in the crypto space. A lot of them seem to be frankly just agnostic and just like, hey, I believe in decentralization and that's my party, right? But that's so fascinating. I wonder if the political voter base feels that way, just because crypto has such a broad, like unlike other things, crypto has broad appeal, meaning like people like it for a variety of reasons, but I'm curious if you could unpack that a little more, because I know that's something of deep interest to you just generally, like partisan division. How does that play out? And do we think the voter base, certainly the Congress people, I think have specific comments, and certainly some things do fit a pattern along party lines, but do we think that goes down to their voter base, or is that just, is that just what they decided they wanted to choose? I love to hear what you think the average person in this division kind of thinks, and why they would think a certain way about, you know, stable coins or crypto or blockchain overall?
You can't kind of divorce the current situation from the fact that obviously a lot of the early interest in Bitcoin and crypto, you know, came from folks with a more libertarian bent, just kind of because of the opportunity to put wealth into something that was not controlled by the federal government, right? That was a very natural way that a lot of the early folks in crypto found their way there, and I think, you know, that's become a much smaller and smaller portion over time as the space has gotten larger. But you know, those origins are still very real, and I think resonate in big ways even today. And you know, obviously, while you know, libertarianism is a thing that doesn't always neatly fit into Democrat versus Republican, certainly I think, you know, libertarians have tended to kind of be more allied and aligned with the Republican Party in this country. And so I think there's certainly that piece. The broader, I think, kind of question that you see now, I think, is individual rights and roles and responsibilities versus, you know, the responsibility of the government to you know, help kind of protect the population, because and I think, you know, where certainly I think a lot of folks on the left are coming from is the feeling that there are a lot of people in the space who are going to lose over time a lot of money, because the truth is there are a lot of scams here, and I think that the space does not do a great job, frankly, of policing itself. You see a lot of projects and scam artists. My one like interaction with this personally was somebody decided to stand up some crypto project, put a website up, claimed I was somehow associated with it, and, you know, got a bunch of my tokens that of course were actually worthless. And then I was getting a bunch of, you know, DMs on Twitter, like, you know, how could you be associated with this thing? How could you lose, you know, I've lost all this money. And it was, you know, and you know, obviously we could all just say, hey, you know, people have to be smart and make decisions themselves. But the truth is, you know, we have a strong history in this country also of putting rules and regulations around financial services products to, you know, help ensure that the average consumer, who frankly just probably doesn't have the time in their day or the bandwidth in their day to deeply kind of, you know, do the deep research and everything, right, that they're protected. And so, you know, I think that you know, a lot of, if you boil it down, I think that's kind of what a lot of this flows down into is, you know, the question of kind of, on one side, what is the role of the individual in participating here, and the other side is, you know, what is the role of government in terms of you know, helping to you know, reduce the risk that the average person gets hurt.
I think that's such a great point about you know, about financial products and innovation. And actually, one of my favorite sort of examples of this in the history of financial products is actually around, you know, the beginnings of tontine life insurance. So of course, you know, you could probably say life insurance is a valuable product today, right? You know, I mean, you pay some amount of money, but you know, it's an innovation that has probably brought more utility than not over the course of, you know, its existence, certainly in the United States. But at the very beginning, you know, and this happens with a lot of financial innovations in particular, there is room for a lot of abuse in the beginning when people don't understand it, even if it's long-term valuable, right? Even if it could bring a lot of value to people. So in the beginning, of course, the tontine life insurance, when they brought it up, no one had made the thought that, you know, you could actually buy a life insurance policy on someone else, right? And so no one had thought of, when they offered this product, the fact that someone could buy life insurance on someone else and then go murder them. And this actually occurred. So they called it murder insurance, right? I mean, it's absolutely absurd when you think about it today, but, you know, this is, you know, brand new financial product. No one really knew the implications or the nth order consequences. And so this kind of happened over and over. Of course, eventually they figured it out and they made life insurance a valuable and safe product. But in the very beginning, you know, there were those issues. So that's kind of one of the stories I like to think about, in the sense of, and it's a particularly extreme story in that case, but there can be damage done when people don't understand the consequences of things. But I think there could also be a danger of saying, hey, this thing could bring lots of value, like tons of value, but because it's so heinous about, you know, the way some people use it, like, do people just like regulate it away entirely, right? I think there obviously is a danger of that as well. So I think finding that fine balance is important, right?
Yeah, no, I think that's exactly right. And you know, I think the challenge here is, you know, like kind of everything in our world from a technology standpoint, it's moving really, really fast, right? And you know, listen, we still haven't I think as a society, even really fully come to grips with how we should think about social media as a form of communication, and how should we be adjusting our media laws that were written decades ago to account for the fact that Facebook does not look like broadcast television, right? We're still dealing with that, and Facebook is much older than is almost a 20-year-old company now, right? And so it is not surprising that we are struggling with this question of how do we adapt our regulatory environment and our laws to account for this technology that it is so different in a whole bunch of ways and opens up a whole bunch of new things. And it is the first truly kind of global financial services product we may have ever had, right? In the sense of anybody anywhere in the world can now transact with anybody else anywhere else in the world with really minimal friction. That literally never existed. And I mean, that's hugely powerful and amazing and opens up all kinds of new applications, but it also opens up, to your point, all kinds of opportunities for new abuses.
And speaking of those problems and issues, we've been talking a lot about layer one protocols, things like Bitcoin or Ethereum or Solana. What are your thoughts around layer two? And I particularly would love to get your thoughts around, somebody with a computer science background and somebody with deep experience in the space. It's like, okay, well, Bitcoin has proven itself out. And as you mentioned, Ethereum even, and probably a lot of these other chains, at least from a cryptographic perspective, I mean, forget, quantum computing and all those things down the line, but, it seems like that part works. But then of course you start layering, things like the Lightning Network on Bitcoin or the various stable coins or even the various DeFi protocols that utilize some of these stable coins. And some of these stable coins and some of these DeFi protocols have billions of dollars of locked value, right? So you could sort of make that same argument of it's being used a lot. But do you think that there's any issues with sort of increased risks as you, keep going deeper and deeper into the layer from a purely cryptographic perspective, or is that not something people really need to worry about? With some of the more
I think there's risks in a number of ways. I mean, one is the truth that one is simply that the technology has gotten just substantially more complex, and the number of people in the world who can actually have the ability to just kind of even understand, it requires to really kind of understand the inner workings requires a pretty sophisticated level of cryptographic understanding at this point. But two, frankly, just keep it all in your head. I mean, so there was a point many years ago, where I could broadly keep all of Bitcoin in my head, kind of the way the protocol worked, because the truth is Bitcoin is not a particularly complicated protocol. I think the truth is, even if I were still day-to-day active in crypto, it would be very hard to keep, pick one blockchain plus one or two layer two things. Like you just couldn't keep it all in your head. It's very difficult. And so, that obviously increases the risks, from a security standpoint. I think that, the other question ultimately, I think is one of integration, back to our point around, kind of vertical integration and to what extent do you need tighter integration between these things for success? I mean, Lightning is probably the good negative example here. I mean, Lightning development, they were developing that as early back as probably 13 or 14. I mean, it is not a new concept, and we still really, I mean, the proof of concepts continue to get better. I mean, there's deployment, but it is not certainly something that is being used at wide scale. And ultimately, I think to some extent, I think there's an interesting question of, is the reason that Lightning has not seen perhaps all the adoption we want to, because there's actually little financial incentive for people to adopt it, which is a kind of a broader, probably interesting question about crypto and incentive structures. But I do think there's risks there. And then I would say that the third set of risks, I think, are really around organizational risks. In that most crypto, a lot of crypto projects, in keeping with the theory of decentralization, run as relatively decentralized operations themselves. And I think there's real organizational risk. We saw that just this week now with Sushi, the decentralized exchange, that it appears like it's kind of blowing up because the core devs are kind of fighting with each other and can't agree on how much people should get paid, and it I think highlights potentially some of the weaknesses of trying to build at scale systems, in a fully decentralized way, right? Because it's not about the geographic distribution of folks. Certainly there are lots of great Silicon Valley companies that run now fully remote, but it's the question of, is somebody in charge, and is there value in somebody being in charge from an organizational standpoint? I think there are certainly lots of, Bitcoin is a great example, obviously, of a project that has remained relatively decentralized, certainly mostly decentralized, although now I think, certainly they have a major benefactor in Jack, and there's a lot of resource being poured in there. But I think that running a project in a decentralized way involves a bunch of friction that you don't have when you have a centralized organization. And I think a lot of decentralized organizations are just not going to be particularly well equipped to handle friction, and will struggle when things are not going particularly well.
I'm curious if you think about the long view. Let's just say like however many years from now. It's always hard to gauge the exact years, but what are some of your, if you had top three or even just top one, but what are your unexpected predictions, or maybe like less than obvious predictions for the space, like in 10 plus years, maybe even 20 years? What do you think we'll see?
I do think we see a Fed-backed coin, and I think we see that sooner or later, and I think it becomes dominant as the stablecoin. I think that a lot of people around the world will fundamentally trust the U.S. government a lot more than they trust what to the average person seems like a very complicated, opaque, not in the sense of obviously it's all open source, but opaque in the sense of like, I can't even begin to wrap my head around how it works, thing where money appears out of nothingness. Like that to a lot of people is going to feel very scary relative to, like the US government told me this is worth $1, so it's worth $1. So yeah, that's one. I think the second is one of the major gaming platforms go full NFT as a way to get out of having to be in the hits business forever, in the sense that, if you could actually transition, your in-game economy to a blockchain that you then convince a bunch of other gaming companies to go build on top of, because you have seeded it with a bunch of players and liquidity, I think it would allow that company that seeds that to recognize value over a much longer period of time, even if they themselves are not the ones generating the future hits on that chain. And again, I think that's an example where, the killer app, if you have a killer app, you could roll your own chain and people will flock to it. And then you reap the benefits of that over an extended period of time. I don't have a third. Those are my two.
No, I think
it's hard to predict.
I think those two are pretty great. And actually, it's funny, given all of our background, even together, that we haven't even, we've only just scratched the surface on the gaming question. I was talking to a very smart VC. This is several years ago. I want to say it was like 2016, 17. So even before the last boom bust cycle. And they made the very interesting assertion, what EA should do, EA, Electronic Arts, the big gaming company, is just go and release a blockchain and do exactly what you described, right? Like that would just be like the best thing that they could do. And of course, a lot of people are flirting with, NFTs and stuff like that, but like what you're describing, is very different. Do we think that kind of player, the player that's going to do that, or the players that will do that successfully, will be able to jerry rig effectively like a blockchain into like an existing platform or whatever it might be? Or are we going to have a brand new player? Because there are brand new exciting players in the gaming space overall, many of which have a strategy that vaguely sort of is in the direction of what you talked about. So is this effectively disruptive innovation where like, the old players won't be able to innovate? Like, can you imagine like trying to put a blockchain into Roblox or trying to put the blockchain into Minecraft? Like, will it be like, and the answer is maybe, right? I certainly don't know. Though I do have some varying thoughts. Like, I think that's a big question. I'm curious to get your thoughts. Is it likely going to be existing player, big player, or is it going to be a brand new player we've never heard of, maybe doesn't even exist yet, or maybe one of the early people now? who actually are successful doing this, because gaming is such a good application of a lot of the things that Ethereum and blockchains like it can offer.
You're obviously much more the expert on this industry than I am, but I think it's in some ways it's a canonical kind of industry disruption question, of can a dominant, an existing dominant player recognize that there is this major disruption opportunity and make a short-term, long-term trade-off, right? Which is to say that, if you're an EA and you're going to go release, a new series, a new game, what have you, and you're pretty convinced it's going to be a killer hit because that's kind of your business, would you actually be willing to say, hey, I'm going to actually sacrifice some near-term revenue by decentralizing my economy? And I'm still going to make some money on it, but I'm probably going to make less, because in the act of decentralization, I'm essentially giving up some economic control and benefits to a wider variety of people. But with the long-term view that it means that, you, EA, we're just using EA here as an example, right? That, EA could actually make money on the next hit that's not their own because it gets built on EA chain. It's a classic innovation question that I'm sure lots of other industries have faced over the years. And I think the fundamental question is, do one of the big, giants have the foresight and the fortitude to go pull it off, or is it too scary? And then, to your point, a new entrant who is willing to take that risk, pulls it off.
I think it's an open question with a lot of unknowns. If I were a betting person on this, I'd probably bet for the new entrant. But you can never underestimate the past successes of these big giants. I'd love to switch gears a little bit and talk about one of our favorite conversations in the past, San Francisco, right? Like the Bay Area. My former residence, a place I still love, and I was just back there recently. Yeah, I'd love to get your thoughts around how COVID has affected the locus of power in Silicon Valley. Silicon Valley, the same old Silicon Valley it was. Is it extremely different? Is it just kind of a little bit modified? I'd love to get your thoughts as a native of many years.
I've been in San Francisco. This is my 18th year in the city proper, and it's a city I love, and we stayed during the pandemic, and I'm glad we did. We certainly have seen a lot of changes when you go downtown San Francisco, and it's pretty dead. One of the benefits that I think we had as a city is the fact that so many of our workers could work from home, because so much of our economy is technology, and I think the city has handled COVID remarkably well. We've had, I think probably almost certainly, number one among, decent-sized American cities in terms of, COVID deaths. And a large part of that is certainly due to great leadership, I think, in terms of public health, but also, frankly, a lot of it is probably people didn't have to go to the office. And so what does it look like long-term? I think TBD, but I remain extremely bullish on San Francisco for a few reasons. Certainly part of it is the capital is still here. Most investors, certainly we'll take a first meeting on Zoom, but at some point, I want to look my founders in the eye and shake hands and get on the whiteboard and do all those things. And that's a lot easier when, more than half our companies are not in Silicon Valley. So we love investing in companies all over, but there's no question that if you are a company, it is going to be easier for you to fundraise in Silicon Valley. That has been true, and I think will remain true. The other piece of it is that while there is amazing talent all over the country and all over the world, and more companies are taking, if not a remote first stance, at least getting more open to high remote talent, which is great. The truth is that there is a real center here of senior talent that is hard to find elsewhere, right? As you grow as a company, and you're getting, you're raising your Series A, Series B, Series C, and you're starting to try to professionalize your executive team and hire folks who have seen the movie before. It's hard to find that for a lot of kind of sectors of tech. It's hard to find that outside of Silicon Valley. And that's because, those people tend to be a little older, they have families. It's just, you're not going to get, uproot your family when you're, in your 40s. And it is much harder to find that kind of senior level talent outside of Silicon Valley. There's certainly some of it in New York, a bit of it in LA, but it's very much centered here. That's a major, major consideration. And then, this is perhaps my bias of me being old and old school. I personally find that it is much easier to be extremely productive when you have a meaningful amount of in-person time. That doesn't necessarily mean you're in the office together 5 days a week. But there are frictions that exist when people are not in the same room and trying to collaborate. And you know, the importance of that collaboration depends on you know, where you are as a company and the types of roles you're talking about and the type of work you're doing, et cetera, et cetera. I don't think any of us would argue that, you know, Zoom is as good as all being in the same room, right? And now there are frictions on the other side in terms of cost of living and commute, and like again, it's always important to think about both sides of that ledger. But there's no question that I think, you know, really top performing people, you put them in a room with other really top performing people, and that's where the magic happens. And I think that's hard to replicate.
You know, the last point is one I've been thinking about quite a lot recently. You know, I talked to a lot of smart people, and I don't have the data on like a GDP level, right? And probably wouldn't for a lot of years, but you know, I just have this intuition, like, you know, things are kind of just getting worse, right? Like, you know, not just Amazon packages taking longer, but like, you know, just everything from like service providers of various sorts, everything just, you know, kind of elongating, and it's like kind of less quality. It's hard to get stuff. And I wonder how much of that is related to, you know, just remote work from a knowledge work perspective. I mean, let alone like supply chain logistics in person. I just wonder, right? Because like, I was surprised to see, obviously, the actual hard numbers. You know, when I was studying B school, we looked at GDP per capita per hour, right, of a variety of countries. And actually turns out, for example, at least the data we looked at, it was like, you know, multi-decade data. And it was like, well, the Germans work less than Americans, but the Germans' productivity per hour is more. So that's about equivalent to the Americans, right? Like, which was fascinating to me. It's like, well, we Americans work more. And this is a very specific sector, so it's not saying this broadly, but it was great to see that data. And then we had, you know, data across a variety of countries. So it was just fascinating to see how different countries had different GDP per hour, you know, per worker. I suspect, and again, I don't have the data, so this is just entirely in my head, but I suspect our GDP per capita per worker on the knowledge work side, due to remote work alone, has gone down. That's just my feeling, my strong feeling, to your point. And I think a lot of that has to do with like the frictions you talked about, you know, and so it's a little bit concerning, not more than a little bit concerning, because now we're gonna have an entire generation of companies that effectively are starting remote first, right? Is that gonna have a long-term effect on us as an innovation leader, or our ability to produce output?
Yeah, agreed. You know, I mean, listen, you know, this last, you know, year and a half, almost 2 years now, it's been a huge shock you know, to everything, right? You know, our society and our healthcare system and our supply chains and the way we work. And I think, you know, we are very fortunate, obviously, that this didn't happen 20 years ago, right? I mean, you know, both on the work side, pre-video conferencing, you know, it's hard to imagine how we could have gotten any work done on telephone. That would be very, very difficult. But frankly, even just, you know, all of us, you know, imagine a world where we're all stuck at home and we didn't have Netflix, right? I mean, we would have all been very bored. So, you know, we are certainly fortunate that we have technologies that have lessened the shock here. But it is still, yeah, to your point, very much a shock. And I think, you know, we are in real time grappling with how to deal with it. And, you know, I think what's interesting now is that this has been going on long enough, and obviously, you know, with our new variant friend here, feels like it's going to go on for a little longer at least. That I think that a lot of the early predictions that things would just snap back are feeling, you know, perhaps less, you know, like that's going to be probably we're not going to see as much of that, simply because we are adjusting to some kind of new normal. And, you know, how long does it take for a behavior to stick? 2 years of something makes things pretty sticky. So
that's a very good point. You know, as an investor or even personally, what are the top kind of themes and things you're excited about?
Remain really, really excited just about the pace of innovation. So on all fronts, right? We've seen more startup formations, and these are government statistics. So startups defined broadly, both technology startups as well as just small businesses. You know, more startup formations than ever before over the last 12, 18 months. That people have taken, you know, COVID and seized as an opportunity to go do new things. And you know, that's from, obviously, as you know, someone who's in the business of backing smart new people. You know, it is great to see more and more people taking the entrepreneurial jump and building companies. So, you know, remain extremely bullish on that. You know, I think the other piece that I think is, you know, this is not necessarily a new trend, but I think it's been accelerating, and the ability to do remote work has really helped this. From our perspective, as venture investors, is the ability for non-technical founders to go build really interesting businesses has only increased over the last year and a half, 2 years. In that, one, certainly the tools have gotten better to be able to stand up something, without actually having engineering development expertise on your team, but also just because, as people have gotten more comfortable with remote work and the ability to do things remotely, and our remote tools have gotten better, it now becomes, I think, a lot easier for a non-technical team, to outsource, whether that's kind of fully outsourcing or hiring a team member or an advisor or whatever it is, but to basically say, hey, I'm gonna have the first version of the tech built by someone who's not a core member of the team. That's gotten easier and easier. And so that's great to see, because I think that I want startup creation to be accessible to as many people as possible, both because I think it's good for the world, but also selfishly, it's good for my business because, it increases the number of great startups that might get created. And so, love that we're seeing that accelerate. I think that's going to continue to accelerate.
I think what you just said is just so fascinating in the sense that, it used to be anathema for core dev not to be, inside, in-house, but the definition of what in-house even means, I think, has changed dramatically thanks to this. I'm so curious, like that actually, what you just said, not being an investor, not seeing as much as you, we're kind of heads down and do our thing. That's actually not a trend that I expected to have arisen already, especially given how well tech companies have done during the last few years. I'm curious what kinds of businesses are doing that. And also when people outsource, like where do they outsource to? Is it like Eastern Europe? Is it India? Is it Southeast Asia? All of the above, a mix, other places in the US, like what businesses lend themselves to not having core tech be part of its like founding team as an example. And also where do they find the tech talent if need be?
Yeah, geographically, it's really all of the above. And I think the right decision there for a founder is really a function of, cost, ease of time zones in terms of communication and also, how much you're looking to outsource. Some folks have a lot of, they might have great product capability, but not the actual engineering capability. So all they're looking to really do is outsource the coding. We see some teams where they've got deep business experience, but don't necessarily have the product experiences. They actually want to have some kind of third party that's handling, kind of a more of the stack there. In terms of the kinds of companies we see where that's an option, it's a pretty, listen, certainly if you're trying to go build some kind of new interesting system using deep learning, that's probably not, you're going to need somebody in your team. But companies that are coming in and trying to address kind of existing industries where technology has not been a major factor and introduce new, workflow tools, new communications platforms, things where the uniqueness of the business is not in the technology, but is in the depth of understanding about the industry and the problems it's facing and the opportunities for disruption. That's where I think you have a business that can be well suited for one where you don't necessarily have to have a founder who is an engineer.
I think it's a great point. And there are actually a lot of great businesses even now, like even consumer facing, being built on, social media, places like TikTok, et cetera, right? And that are doing fantastic.
Yeah. Well, and listen, if you're building at this point, if you're building, a marketplace, a e-commerce business, or even an e-commerce, even an e-commerce marketplace business, there are a lot of, essentially out of the box platforms that you can use with some, third party kind of customization help that will get you to an MVP.
Yeah. That's such a good point. That's a fantastic point. What a different world we've come to, right? Compared to a decade ago. Well, Matt, this has been such a fascinating conversation, as always. I truly appreciate all the insights, the wisdom you shared with me over the years, but also all the great knowledge and thoughts that you've shared with us today. So thank you so much for joining us.
Thanks for having me. This is great.